Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of General Mills and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with some background info on General Mills. General Mills was founded in 1866 in Minneapolis, Minnesota. The company's first product was gold medal flour, and it quickly grew to become one of the leading flour producers in the United States. In the early 1900s, the company began to acquire other food companies, building itself into a food conglomerate. Today, General Mills' product portfolio has expanded to include cereals, snacks, and frozen foods. It is one of the largest food companies in the world, with brands that are familiar to people all over the globe such as Cheerios, Pillsbury, and Häagen-Dazs. Starting with the 1-year chart, we see that General Mills had a CAGR of about 1.4%. Zooming out to the 5-year chart, we see that General Mills had a CAGR of 11.3%. These are good returns. Now, let's take a look at the fundamentals. Gross margin is good at 33%. Revenue has compounded at around 5% over the past 5 years and has topped $20 billion most recently. Good revenue growth and strong gross margin makes me hungry for more. Let's explore. Looking at free cash flow, we see a 1% CAGR over the last 5 years, while capex has increased at a CAGR of 2% and stock-based compensation increased at a 8% CAGR. Diminishing free cash flow and growing capex and stock-based compensation is a bit worrisome. Thought stock-based compensation is very small. General Mills appears to be allocating increasing amounts to capex. We will need to keep an eye on this. Next, weighted average shares outstanding have actually increased over time, which is the opposite of what we want. However, since 2022 the number of share outstanding has begun to decrease slowly. We could be hopeful that General Mills restarting buying back shares when the company is undervalued, though the diminishing free cash flow calls this into question. If free cash flow is increasing, I would feel more confident that share repurchases would continue. Now let's view my favorite metric, return on invested capital. Return on invested capital has fallen from 11% in 2018 to 10% most recently. Though it had a big run up during the hyperinflation period from 2020 to 2022, the recent fall in return on invested capital is not ideal. Another favorite metric is cash conversion cycle, a measure of operational efficiency at the company, going from 5 days in 2018 to -68 days most recently. General Mills is demonstrating improving leverage. Seeing this means that they are improving efficiency and managing their inventory very well. Last, let's explore General Mills' debt metrics. The current ratio is 0.7. The debt to equity ratio is 0.4, and the net debt to EBITDA ratio is 3.6. Not too bad. The fundamentals of General Mills seem okay, but honestly, I was expecting much better free cash flow growth and stronger return on invested capital. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for General Mills. It is a food company with a gross margin of 33%. The 5-year revenue per share CAGR is 4% and the 5-year free cash flow per share CAGR is -2%. Again, not great revenue growth and sad to see free cash flow per share decline. A return on invested capital of 11% is good, but it is on a downtrend. Next, the cash conversion cycle of -68 days is pretty good. Very happy to see this. Concerning debt, a net debt to EBITDA of 3.6 means the company can pay off its debts with less than 4 years of EBITDA. So from a fundamental standpoint, General Mills is okay, but with the American consumer remaining strong for the moment, perhaps the fundamentals will improve in the midterm. Now let's switch our attention over to valuation. General Mills is undervalued relative to the S&P 500 with a ratio of 0.8. It is not expensive by this metric, but there may be a reason for that. The price to earnings growth, or PEG ratio, is 2.2, which is within expected range. General Mills is a historic, blue-chip food company that has stood the test of time. It is essentially at the cash cow phase of its business life and is not expected to have rapid revenue growth. However, it should provide a centering position to any portfolio. To wrap it all up, General Mills is a solid company, but negative free cash flow is a bit dissuading at the moment. Let's put it on the watch list and see what else is out there. Many thanks for watching. What do you think about General Mills and its valuation? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.